All right. Well, look, thank you folks for joining. Really, really appreciate it. Thank you for taking the time. I want to start by quickly introducing myself and Pilot. I'm Waseem Daher. I'm CEO and co-founder of Pilot. This is actually my third startup. Our previous startups, one was acquired by Oracle, one was acquired by Dropbox. And we started Pilot to solve a problem we very viscerally had ourselves. And what we do basically is we specialize in bookkeeping, tax prep, and CFO services for high growth startups ranging from pre-seed to Series D and beyond. When you work with Pilot, you get the expertise of a finance team that takes the work off your plate so that you can focus on running your business. We're the largest provider in the space, working with 1,000+ startups. If there's anything we can do to help out, please don't be shy about dropping me a note. I'll put my contact information in the chat after this. And I'm super excited to be joined by Lukas Wagner, VP of Finance at Pipe. Lukas, would you like to introduce yourself and maybe tell the audience a little bit about your story, a little bit about Pipe?
Yeah, happy to. Luke, as you said, Lukas Wagner, originally from Germany, went to the US, came back actually in Frankfurt, Germany right now. So we're doing prime time 8 p.m. show right now. VP of Finance at Pipe, responsible for all things, just classic corporate finance, happy Pilot customer, but also all things that are very specific to Pipe. We can dig into that later. What is Pipe? Pipe's a two-sided marketplace, a trading platform, also dubbed the NASDAQ of revenue, where we connect recurring revenue companies on one end, so folks that have subscriptions or any type of recurring revenue from their customers, with institutional investors on the other side that are purchasing those contracts as a fixed income-like instrument, which allows the companies to grow on their own terms without debt or dilution, and allows the investors, obviously, to have a very secure, a very stable fixed income like yield income. Before Pipe, I was the first finance hire at a company called Fair in the mobility space, so subscriptions for cars. Scaled that from 15 people to about 500 when I left. And actually, during my journey there, met Josh and Harry, now the co-CEOs of Pipe, because we acquired their last company in the rent tech space. So we bought the company, we got along great. And when they set out to create Pipe, I was fortunate enough that they found a reason to tap me on the shoulder and said, hey, you wanna come along? So that's why you find me here.
Awesome. Really glad to have you here. And then obviously, thank you for being a Pilot customer. I know we've really enjoyed working with you folks. And, I think one of the things that would be really interesting for our audience is just to talk a little bit about really sort of like what are the financing options that exist for companies? And maybe as a precursor to that, perhaps we can each talk a little bit about our previous experiences and maybe how those companies were financed, just to maybe set the stage here. And Lucas, do you want to kick it off for us?
Yeah, absolutely. So maybe starting just chronologically with Fair, right? Fair as a car subscription company, super capital intensive business, right? In order to buy cars, I mean, everybody's gone through the experience probably for themselves, but if you go through that at scale, right, you're always raising debt and you're really also always raising equity, because even just the operations of managing the entire fleet are really, really capital intensive. So, when we were at Fair, we were always fundraising either for debt or for equity. You close one, you go move on to the other, and there never really is an end in sight. Now, bringing Pipe, obviously a lot of equity fundraising experience as well. We've raised over $300 million at this point. And obviously are also always raising, debt-like capital, not for ourselves, but for our trading platform, right? Capital markets investors that want to buy assets on the platform. I think really the key difference between my two experiences is that in one, and you're really raising just to keep feeding this machine, this beast you're building, even if it's very positive, right? Like all of the numbers are trending up, right? It's a never-ending story. Whereas in the Pipe situation, really we're very strategic about who do we take money from? Why are we taking the money from those folks, right? If you look at our last fundraise, right? A lot of strategic investors, public companies with their balance sheets that are working with similar customers that we are lucky to serve. So there is a lot more strategy behind the actual fundraising process. And I think that that's something that is truly important to consider when you're taking money, is not only what form of money it is, but also obviously who the partner is that you're now tied to the hip with for, at least until there's a liquidity event.
I could not agree more. And our fundraising story has been really interesting. So this is our third startup pilot. Is we had a company, the first company we did right out of school was this company called K-Splice. We could do software updates without rebooting. We did that company in Boston. We actually totally bootstrapped it. We got started with a little, we won, it's a little bit more complicated actually. We won a business plan competition, and then we got a government grant, actually an NSF SBIR grant. But other than that, that's sort of what allowed us to get started. Other than that, we grew basically by selling our service. And if we wanted to spend more money, well, we had to make more money. It was very, in some ways, that's how 99% of the businesses in the world work, but it was a very traditional approach to building a company where we were bootstrapped, we were very cash constrained, we were very focused on the cash balance and our cash flow at all times. In the second startup, which Dropbox acquired, we raised a pretty sizable angel round, and the company was acquired prior to our raising a Series A. So in the second company, we sort of experienced the seed round angel investing world. And then Pilot has very much been a classic kind of venture-backed model where we've now raised a Series C, where backers are like Sequoia, Index Ventures, Stripe, Bezos Expeditions, a bunch of folks. So very, very much the kind of classic venture capital approach to financing the business. And I think one of the things that's interesting, Lukas, is that you and I bring a pretty diverse set of perspectives on this. And I think one of the things that I know you and I were talking about previously, and I could not agree more, is that fundraising is not the goal. It is a means to an end of actually kind of operating the business. And so I wanted to maybe have a chance for us to talk a little bit about thinking through various options. So you're an entrepreneur in the audience, how should you think about, is VC right for me? Should I think about angels? Should I think about alternative options? Maybe curious if you have any initial reactions there. And I know that I definitely would love to share some thoughts on how I think about angel investors.
Yeah, I'll leave the angels to you. I think just and we get this asked a lot. Obviously, we talk to founders across our team every single day, right? The first 100 sales calls, 200 sales calls that we had were Harry and myself talking to the founders of all of these companies about what is really the best path for them, right? It doesn't make sense for us if we're forcing them into a path that doesn't make any sense for them. I think the one thing that really stands out is that folks really need to understand the power law of VC money, where in the end, they're looking for those 2-3 home runs. They're looking for their Coinbase. They're looking for their Uber. They're looking for those portfolio makers that end up letting them raise another fund. If you take money at, a 10, 20, $30 million valuation early on, they're not interested in you building this into, a 40, 50, $60 million valuation company. You as the founder might love that outcome, right? It might be life-changing money for you and your family, for your early employees. Everybody ought to be happy. The VC isn't going to be happy, right? And that's okay. But it's just something you need to understand when signing up, right? So as appealing as obviously both you and I have been very blessed with our respective companies about attracting great investors at great valuations, but really, what you're signing up for, right? And that is really, rapid growth and a lot, blood, sweat, and tears along the way of making it worthwhile, not only for yourselves, but also for those people that came to support you early on.
I definitely agree. And I think, sorry, go ahead, Lukas.
I was just going to ask about how you feel about the difference between those type of institutional venture capital, and then the earlier the solo capitalist, the classic angel, right? Executives at other companies. Where do you see kind of the main differences, and what's your feelings towards angels in general?
I'm a huge fan of angels, and I'm a huge fan of angels because I think that, and again, all of this is kind of coming from a position of the assumption that you're able to raise money. If you struggle to raise money and someone is willing to write you a check, you honestly probably don't have the luxury of, would I rather this person's money or that person's money? Right. But hopefully you do have that kind of optionality. And one of the things I like about angels in particular is that there's a real opportunity generally for your angels to add significant value that isn't just dollars and cents. I especially really like, and obviously I'm biased here, is like the sort of angel operator, like someone who has been in your shoes, who's been an entrepreneur, who's seen the movie before, who knows what it's like, who knows about the ups and downs. I just think like that high degree of empathy can be useful, both in terms of like very tactical advice that they might have for you about how to run your company, but also honestly just as like an emotional sounding board where it's like, okay, you know what this is like. And I think one of the things that's challenging though about angels is it's kind of hard to know in advance like whether your angels will be useful. And I think about angels as actually falling into maybe one of three buckets. The one to avoid is like basically what I term malicious angels. And you'll rarely see this. It's like rarely intentional bad behavior. It's rarely like that they're trying to screw you over. But more often it's just like, I don't know, they're slow, or they have a million questions for you, or they delay the close of your next financing. Like your angels ideally are helping make you successful. I think if you get the wrong folks on the cap table, they can apply a lot of stop energy in a way that can be frustrating. So bucket one is this kind of like malicious persona. Bucket two, and I think this is where the vast majority of people fall, is neutral, which is like they wire you some funds and you basically never hear from them again. And actually, I don't think that's a bad thing in the sense that they're helping you fund the business, they're low hassle, they don't take up your time. And hopefully if you reach out because you need something very tactical from them, you have a good shot of getting them to do it. All things that's pretty good. And then I think the rarest, but the best is really this kind of like transformational type of angel. Sometimes you just, again, extremely rare, but sometimes you just run into someone or happen upon someone where their impact on the way you run your company is enormous. Like they'll be trusted thought partners to you. They'll help you navigate sticky situations. They'll serve as sounding boards for tricky stuff. And there'll be advocates who also introduce you to top tier investors. You're like delighted to have them. Now the challenge is like, okay, we talked about these three buckets. It's kind of impossible to tell who's going to be in that bucket three from the jump. So in general, my view, and I think this is a little bit contrarian, is I like to get as many angels on the cap table as possible, because that increases the probability that we're going to get someone really great, assuming we feel like we can filter out the folks that are actually going to be harmful.
I think given all of the tools that are out there now, right? Like think roll up vehicles, or, obviously having even just, Carta, which didn't exist, 20 years ago, in order to manage your cap table and some of the legal processes. I think that's actually something that now is attainable, right? That's quite frankly why, both in our fundraising, but also now me working with a lot of, products that I use where, myself or Harry, Josh, Zane, we start investing in some of those, and just the network builds itself. And it's helpful to have, one of your customers as a sounding board, right? We have a few of our biggest supporters early on are now investors in Pipe, right? And it's been tremendously helpful to have them be aligned with us strategically, but still having gone through the full experience early on and being very, truthful about it, right? Giving really candid feedback that you might not get from, an outsider's perspective. So I'm completely with you there.
And you talked a little bit about how VC, is not necessarily right for everyone. And I could not agree more, where I think, the math on this is not quite right. But, we bootstrapped our first company and we sold it to Oracle. And then we raised some angel money in our second company and we sold it to Dropbox. And actually, even though the second company was sold for a larger amount of money, the first company put more money in my pocket because of how the sort of ownership was structured. And I do think that it's like, you sort of have to soberly ask yourself what it is you're trying to achieve with your company. And then maybe the venture-backed path is one that is suitable and appropriate for you, and maybe it isn't. And that doesn't mean your company is any less great. I want to really kind of emphasize that for our audience, which is there is more than one way to build a business. I don't believe that there is like the good way and the bad way. A good business is one where you're building something people want. And like how it's financed, in my view, is a detail. It's not the end that you're trying to achieve. But having said that,
just one thing on that. I think it's very easy, especially, in the days of Twitter, in the days of Crunchbase, TechCrunch, very easy to get, sidetracked by all of the fundraising announcement. And obviously it's great, right? Like it means you've built something that other people value. But we all, every single day we run into founders that have just quietly, just by virtue of maybe a small angel checks early on, built behemoths that they just fully control, right? Like they own 90+% of this, and they're just quietly skating by in the background, not caring about all of the noise. And I think that's also a path that can be super rewarding and allow you a lot more freedom, a lot less masters to answer to, right?
Yeah. And what do you think makes a company ready for venture capital, or what are the criteria you'd look for to say, oh, this is a business that is suitable for, going and raising a traditional institutional round?
Well, I think the first one, right, is like, what's your TAM, right? Like if you play your cards right, if you execute with the right team and the right timing, is there a big, really big company to be built here? Or are you serving a potentially very profitable but very niche market where even if you get to 60, 70, 80% market share, right, like the outcome ends up not being maybe what an Uber or DoorDash could attain, right? Obviously, those are super, food and transportation are, some of the biggest TAMs out there, but there's a lot of gray space in between. But I think that's the first question someone has to ask themselves. I think the second one, and that really is more so from a, how do I run my business when leading up to the fundraise? Have I found the right level of product market fit, rinse and repeat type business, where when other folks look at my metrics without any bias, are they going to see this? Because what we quite frankly run a lot into is companies that are, they want to raise institutional capital, but they're just not quite there yet. And that's okay, right? But what you want to do is you want to run your business in a sustainable way, so you're not relying on outside funding at like a specific point in time. And I think that's where alternative funding mechanisms, which we'll talk about later, can help you really bridge that gap, build yourself a really healthy business. And then, if you want to go shoot for the moon, it's all good. You're ready for it.
Yeah, totally agreed. I mean, I think there's sort of like there are two questions, right? There's, can you, like, do your metrics support institutional funding? And then maybe, should you? And for me, the answer to should you is you sort of have to believe it's exactly what you said, Lukas, which is that the market is super large and that you have appetite to really pour on the gas. And in particular, at the expense of trading away some ownership in the company, you're going to use that because you want to grow super fast, because you believe that growing super fast is needed to ultimately create the scale of value you want to create. And to give you an example, in our previous company, Zulip, we were building a group chat tool for businesses. So basically we were trying to build something like Slack. I think we've all seen just how big Slack became. So, I think we were right that the opportunity was large. There was stuff I would do differently on the execution of that particular company, but the thesis was right, which is, okay, there's this huge opportunity. We want the cash injection so that we can move fast because we believe that there are outsized benefits to kind of making that traction in the marketplace. And of course, the same thing is true at Pilot. We're solving a problem, this kind of accounting and tax problem, that literally every business in the world has. It's an enormous opportunity, and we would rather pursue it more rapidly than more slowly. We know that it has the potential to be really huge, so we're willing to kind of do the work to give up some ownership, take in some additional capital to allow us to kind of realize that vision faster. And I think in some ways the question I would ask is, does the business require venture capital to succeed? And if it does, great, you should do it. And if it doesn't, I view that as a good thing.
I actually would even go one step further. We've talked about kind of the early stage of the company. I think they're even at a late stage of the company comes a time where we've all seen the alphabet game being played, right? Like X, Y, and Z raises Series H. I don't know what they've been doing other than just fundraising for the entire history of their company. But I think once you have a really rinse and repeatable business model where things are not longer, moonshot R&D type things, or geo expansion, which may or may not pan out over the course of 12 to 24 months. I think things like PIPE or similar type of financing mechanisms, even traditional debt, when it's just about rinse and repeat type things, are much, much better than selling 15, 20% of the company that you've worked so hard to build over the last 15, 20 years. If you look at, the S1s from DoorDash and some of these other folks, where you end up with the founding team owning sub 10%, they had all amazing outcomes, don't get me wrong, but I think there's now a movement with a lot of founders where they're really trying to, balance. As you said, when it's time to strike, you go raise outside capital, but there's also a stop button where you've now hit escape velocity, and just raising for the sake of raising, I don't think serves anybody particularly well.
I agree. And I want to go a little bit deeper on that in a bit, because I've always thought, the conventional wisdom, well, I think what should be conventional wisdom is, equity is sort of the funding method of last resort. Ideally, you grow based on your revenue. And if you can't grow based on your revenue, you grow based on debt. But historically, lenders would not issue you debt because you're some scrappy startup with no assets. And then so finally, your only option in your menu was, the option of having to sell equity in exchange for cash. And the landscape is shifting here, which I think is actually really, really beneficial for startups. But one of the things I want to get your perspective on is how do you think about, the strategic VC round versus maybe a more just pure play kind of straight round? Talk to me a little bit about kind of funding as a strategic move and not just as a kind of financing or cash move.
I think, and I've had this experience both at Fair, where Daimler and BMW were investors, right? Helps for an automotive startup to have those guys in their corner, but also now at Pipe, where in the second to last round we had a whole host of public companies, Okta, Shopify, Slack, HubSpot, all investing off of their balance sheet. In order to really help us create these deep partnerships, these deep integrations with these companies that already serve the same or very similar customer types that we serve. I think it's the best door opener you can have, right? The moment they invest from their balance sheet, they have executive buy-in that this is something they think is worthwhile entertaining. So you're then running in open doors thereafter as you try to actually make the partnerships manifest. I think where I would caution is that the moment you go open these doors, it takes very long, and that's by no fault of theirs. They're publicly traded companies. They simply can't move as fast as a VC fund where they have a singular GP or GP committee. That's, they make a decision, they fund tomorrow. Whereas with these folks, right, there is auditors to be talked to. There's a bunch of stuff that needs to happen for it to manifest. So if you're strapped for cash, that's probably not for you, right? And then also, the moment they come in and they identify that, that might be an opportunity, you then also thereafter have a duty to help deliver for them, right? They're not in the business of betting on companies being successful. They're in the business of making their own shareholders' value appreciate, which happens by virtue of them adding new customer segments, getting their products being distributed in the world. So when they then come knocking and they want to, build on the partnership and build integrations and the like, you also need to be ready to expend the resources to do so. So I don't think it's something to think of when you are, 10 people with an idea and a few beta customers. This is really an idea when you're trying to go from 1 to X and want to hit escape velocity. That's the moment you should think about bringing some of these on. But I think then it's a lot more value than having somebody just write a check.
Yeah, no, I completely agree. And I think one of the things that is interesting is emerging, and not just in kind of startup financing, but across startups generally, is just the new landscape for kind of how companies are run. And you look at companies like Pipe, you look at companies like Pilot, in terms of what founders and business owners can now do that they weren't previously able to do. And we talked a little bit about this as far as Pipe is concerned, which is good luck historically getting a bank to give you a loan against, your ARR or really anything related to your startup. It just wasn't an option that was on the menu. Now it is. And I think, that optionality is really good for founders because why would you not want more choices? It's just sort of another tool in your toolbox that you can kind of strategically deploy. So I'd be curious, can you give our audience a little bit of color on maybe Pipe and how you think of it relative to something like venture debt or factoring of your receivables or some of them maybe older school things that used to exist in the space?
Yeah, absolutely happy to. So yeah, Pipe is, so first of all, I have to correct you. It's not a loan. It is a true sale of an asset. So it's a
Totally.
true sale of receivables. Has a bunch of benefits, obviously, not taking on a bunch of leverage. However, really the key feature about what we've built is that we've made access to capital incredibly easy. So for any company, we work with companies all the way from about 100K ARR, so some level of product market fit, all the way up to publicly traded companies, hundreds of millions worth of ARR, have served all of them. It's really easy to, and I would encourage everyone here that has a recurring revenue business to just try it out, costs nothing. Link your bank account, accounting systems. Ideally, they're prepared by Pilot. They're always top-notch quality. And then they're your subscription manager. Our system ingests all of this data, rates your assets for our institutional investors on the platform, and then displays you trading limit and a bid price for your assets. And then if you decide to take the leap, either today, tomorrow, 30 days from now, or a year from now, you just click the trade now button and the money is in your account same day or at the latest next day. And it's a much easier way of going about at least finding out what you can get versus going through the painful process of calling up your preferred banker and going through, a 4-week due diligence process where you're sending over, CSVs back and forth and hand signing documents just to get to the place where you actually know what you can get. And I think that's, as you said, wasn't possible in the past, right? Now having all of this data being digital, having all of these systems, whether that's, Stripe, PayPal, Braintree for payments processing, whether that is, QuickBooks Online, Xero, and NetSuite for your accounting books, or just Plaid, Yodlee, and all of those guys that are making banking data incredibly accessible. They're allowing folks like us to do what we do best, which is then, ingest that data, cleanse it, evaluate it, and make sure that the process for the founder is really as seamless as just punching in a couple of passwords and then having the option on the table. I think in terms of how we differentiate ourselves, I think, we're currently very much, we started being focused solely on SaaS. I think that's, where we came out to market with, for one simple reason, all of those folks have all of these tools that I just described off the table. So that was just the easiest entry point. I think what was really surprising to all of us, but is a really positive development, is that last month, more than 50% of what we did in terms of, trading volume was non-SaaS. So we've done anything from traditional real world businesses that is like property management, right? Tenants pay every month. So it's recurring payments. VC trading their management fees. And then any D2C customer, D2C subscription businesses, and a whole host of other activities. Also in terms of use case, we started really with growth-focused financing. We've now done what we dubbed the unlevered levered buyout. So we have a partnership with MicroAcquire, where we allow folks to buy SaaS businesses or online businesses in general by using the target's ARR in order to do so. And also really, and this is, I think, where you're hinting towards, and sometimes replacing an equity fundraise or a traditional debt fundraise. Now, we're not an absolute alternative. Ideally, a company makes really smart decisions along its way. Potentially, if you don't have any capital of your own, it's very good just to have a friends and family round or find a couple of angels in your industry to start, finding some product market fit, building your beta product. I think then ideally, you have a little bit of revenue and you kind of keep growing organically a little bit. And then potentially, it makes sense to either raise a VC round, or if you're just very fortunate that your product is just crushing it, you start using something like Pipe to trade your revenue and grow that way, right? As long as you have a good formula where what you pay to the institutional investors that end up buying your assets by virtue of the discount, if you know that you can get more of a return on investment into your marketing engine, right? It's a very, very easy math problem that, just becomes this perpetual wheel of incremental ARR, incremental trading limit. You can trade more should you want to, as long as your mechanics keep working that way. It's incredibly well. I think in terms of the actual comparison to the other pieces, right? I think, as you said, equity, while really good early on, because you don't really have product market fit yet, you might be doing, you know, R&D type moonshot things where you don't know what your payback is really going to be. Really helpful, right? Like we've raised a lot of equity. We believe in it helping us de-risk our business. We have really big plans, really big ideas, really big expansion plans. So it helps to have a war chest that allows you to do that. But I think as it just relates to marketing and any of the other kind of growth investing, right? It's not the most efficient use of capital. If you look at any of the successful companies that actually went to liquidity and you back into what their cost of equity was, very, very unfortunate, because what the couple thousand X on their Coinbase investment was, if you just like reverse engineer the math for the investor, that's what effectively the founders and the early employees paid in cost of equity. I think in the end, in that situation, everybody is happy, but it's just important to kind of keep that top of mind. Equity is not free, not because there isn't an APR sign, you know, right next to it. I think in terms of venture debt, it's very interesting. Any company I've worked at, we've raised some venture debt early on, and I think that that's, you know, very helpful early on. It gets you a lot of legitimacy. A bank has looked at your business, they've deemed you credit worthy, right? It's almost like, you know, a little bit for something for your resume as a company that this has happened. All of your, you know, corporate structuring, all of your documents are, you know, put together really nicely. They're happy with it. But it is really expensive because not only are you paying an APR, you usually also give the bank some warrants for the pleasure of giving you the money with an APR attached. So it's a blend of both worlds, but it's usually fairly inefficient. And then last but not least, I think in terms of just traditional debt, if you have a business where, for example, you want to buy fleets of cars, or you need to buy machinery, you know, like you're a solar company, right? You're buying solar panels. It's a really well understood asset class. And you can find institutional investors to go give you money at, you know, 2, 3, 4% APR at scale tomorrow. You should very much go for it. But if you're none of those things, which just most companies in the world are not, then I think that there is a much more efficient way, which is, you know, I think the marketplace model that we've introduced to the world, where, you know, everybody gets what we think is the fair cost of capital for their respective business, from the public company all the way down to, you know, bootstrapped 100K ARR.
Totally. I mean, I love this idea of it's sort of like democratizing a capability that used to exist for large companies only, and like now you can make it available to everyone, which is pretty cool.
Exactly. And I think, look, if we just talk about, you know, the tech environment in general, right? Like any big tech innovation over the last, you know, 20 years has really been about, you know, trying to build something that used to be very expensive or used to be very hard to scale, and like do exactly that, make it very cheap and make it very scalable, right? Whether it's black cars with Uber, or whether that's, you know, getting an office in like a nice high rise in New York, that's WeWork, or any of the SaaS products out there, right? And obviously, you know, you and us are doing it for this next generation of founders that I think they want to be a little bit more independent. They don't necessarily want to have 10,000 people working for them, but you allow them to still have, you know, amazing accounting expertise, effectively in-house. And we do the same thing by virtue of, you know, being able to go to the capital markets without needing to hire a banker to do so.
Totally. And I want to ask you one last question before we turn over to the audience for Q&A. You folks have been a pilot customer for quite some time. Curious kind of how you decided to make that choice versus building the function in-house, or, you know, some other option.
Oh, absolutely. So look, I think in my previous life at Fair, we built a really good internal accounting team, but it's, you know, it's capital intensive, and it's just for your CFO, controller, whomever leads your finance department, VP of finance. It's an additional area where there is experts out there. It's not your core expertise. Not a singular tech company, I think, goes out there and says, we're the best in the world at accounting, right? Like that's reserved to folks like you, that's reserved to their respective auditors, but you're not adding any value. And I'm all about looking at, you know, all of the things that you do. Where can you be the best or one of the best in the world at? And we just realized accounting wasn't going to be one of those things. I actually, funny enough, did our early, you know, first 3-4 months of operations. I just did the books by myself. Your team was not really happy with me when we actually ended up making the jump. But we just decided to look outside and see, what else is there. And I think, by virtue of you guys being, tech forward, using a lot of integrations, making it very seamless, that's what we're all about. So it was a logical choice for us. And I think, since we've also, started utilizing you guys for taxes, never had an issue there. So I think, it's great to not have to worry about those things, because those are things where you cannot really win a whole lot, but you can certainly lose a whole lot. So knowing that those are in good hands kind of, is pretty much no brainer to me.
Nice. Glad to hear that. And very much resonates with what we set out to do, which is the reason we started the company was we struggled with this pain ourselves. And I would rather the founder focus on the specific, let's call it like their high leverage use of time or their specific area of expertise. And then when we're taking care of it on the back end, they can sleep well at night knowing that we're bringing our expertise to bear on it as well. That's great. Listen, Lukas, thank you so much for the time. I'm glad we had a chance to chat. I know we have a little bit of time remaining. I'd love to maybe flip into our audience Q&A. So folks, if you have questions, feel free to submit them with the Q&A tool in Zoom. We've got a couple here that I'm going to start working through, but please don't be shy about chiming in here. We've got one from the audience. What's the most interesting or unique revenue stream that's been sold through Pipe so far?
Well, I think going back to what I just said, and I kind of like mentioned it, was we set out looking into SaaS, right? And all of a sudden we met this incredible team of founders that are working in the property management space, and are basically, trying to put a modern, more higher tech spin onto it. And that was like one of those light bulb moments where we just realized, look, really anything at this point, right? If it's not a subscription yet, it's going to be over the course of the next couple of years. And there's these, revenue as an asset class, right? Like you'd never run out of new verticals to go into. But I think given that was such a light bulb moment, I think, management fees from landlords and tenants was definitely up there. It was very interesting.
Sure. Nice. And I also like the VC management fee example as well, which is
exactly right. Like if you're slightly putting them out of business, you at least might, allow them to pull their cash flows forwards to make a couple of investments.
Sure, exactly. And then we have a couple questions from the audience about maybe the early days, which is any recommendations for someone just getting started, or maybe someone who thinks they want to start something but is searching for ideas? Any guidance on how to get ideas for potential projects that you think are worth tackling?
Well, I think really the way that I see it, and like the moment you started, I think there's a lot of, big entrepreneurs that have said this before. So this is like not novel, but it's really looking at yourself in whatever job you're in, or, at your friend's family, and just seeing things that they don't enjoy doing, but still have to do, and it's wildly inefficient. If there's a way to somehow automate them, make them easier, make them more fun, I think that's always a good place to start. I think like if you look at, a lot of these SaaS tools, right? Like all of them kind of evolve from stuff somebody used to have to do in Excel. And now all of a sudden there's like a specific tool that allows you to do this one thing incredibly well. It's like the unbundling of Excel, for example. That's just, I think always a good place to start.
Yeah, I tend to agree. I have a couple posts on Substack about this, if folks will permit me to shill from my own content here that I've just put in the chat, where I think the first question that folks should answer is like, why do you want to do a startup, and will it actually achieve your objectives in terms of both like, what are the things that make you happy? Are you trying to, work towards a particular financial outcome? If so, what does that imply about how you fund the startup, et cetera, et cetera? And then on the tactical side, I think it's exactly kind of as Lukas mentioned. The things I like to look for are targeting a huge market, solving a real hair on fire problem for folks, making sure there's an easy way for your solution to be adopted, and then really just like talking to who you think you are, your customers, to make sure that there's actually like strong fit there. Because ultimately, like, what is a business? A business is you believe there's a problem that exists in the world, you've come up with a solution for it, and you sell that solution to people who have the problem. And if that last piece is missing, you actually don't have a business, you have a research project. And so I would encourage you, as you think of as you're searching for ideas, you can look for your own pain, you can look for pain that's in your network, but like you gotta talk to the user to make sure that that sort of visceral pain, is in fact there and that your solution really addresses it.
And they're willing to pay for it, right? Like that's the one thing
Totally,
you mentioned. I think is super important.
totally. Um, Another question that we have from the audience is, look, in the early days, like we're talking about the very early days of the startup, and you're trying to kind of get off the ground, you're trying to get a little capital, but you're pre-revenue. Any tips for how to kind of get that started in a way that maybe minimizes the amount of equity you have to part ways with? I mean, unfortunately, at this stage in the company's life, they're too early for something like a PIPE. Any other maybe thoughts or guidance for folks as they think about that initial funding?
Look, I think initially, right, like the product is key, not the funding, right? I think like if you get the product piece right, the funding will come. I think, going into whatever topic area your business is in, joining, communities in that area and talking to folks about their problems and how you can solve them. I think spinning up, having a product, even if it's a bad one, is better than not having a product, just like an idea in a couple of slides. So I think, taking any of the, countless no-code tools that exist these days, taking a weekend and, building, effectively a mock-up with a few features that actually work of what you think the product should look like, and then showing it to those people that you've met along the road, I think is a great way to get started. And then I think one thing that's incredibly important, obviously, both at Fair and now, with Harry, Josh, Zane at Pipe, in the end, the CEO, the founders, they need to be the best salespeople that you have. And you basically need to go out there and need to drum up interest. And it doesn't matter whether that interest is partners, investors, or ideally customers, because they immediately put, money into your coffers. That's really the first thing that you have to solve for, right? And I think solving it for individual use cases and a smaller group, and then hopefully it ends up being scalable. But I think, finding those first couple of paying customers is big.
No, I totally agree. I mean, in some ways, this is like a little bit of annoying advice, but I think it's true. Is like the easiest way to get funding, regardless of what the funding source is to have a business that is working.
Right.
And there isn't a cheat code. Like the thing you most want to do is demonstrate concretely to folks that, hey, there are customers out here that find my thing valuable. They're willing to pay me for it. And either they are paying me for it and therefore that's how I'm growing my business, or I'm financing it in some way, or I have strong enough indication that they are willing to pay me for it that I can use that to raise money on terms that I'm comfortable with. And in some ways, it's just like the focus on how do I raise money is in some ways the wrong question to ask. The question to ask is like, how do I build a business that is strong and growing? And if you can do that, the fundraising pieces sort of unlock themselves is sort of what I've experienced.
And I think one, and I'm very, very biased here, but there is natural entrepreneurs out there that should just start their own thing from day one. I think what helps, unless you have a really experienced co-founder, is to have just joined a, early stage startup, or at least a growth company going through this like growth spurt moment, and having learned from people that have been there, done that for a little while, because it will teach you a lot of those things, right? Like all of the big companies that we now all know used to start with, a couple guys in, garage, small office, wherever they ended up starting. But I think, learning to crawl before you run certainly usually helps. Now there's exceptions to the rule, but I think it's definitely, the second time around is always easier than seeing things for the first time, and allow you to know what to look for.
Certainly. Yeah, I could not agree more. I think the second time, or in our case, the third, like go number 3 has been a lot easier than go number 2, which was in turn a lot easier than kind of go number 1. And so just having seen the movie, whether you were the founder, whether you were an early employee, certainly, I mean, it is definitely a nice boost. Cannot be understated there. Let's see. Okay, another question we've got. This one is for me. For Waseem, how do you think about the proliferation of outsourced accounting companies and avoiding pressure to lower margins? And I think this is maybe to ask the question more generally is like, with any company, if the company starts to succeed, you will see the emergence of other players in the market, and sort of how do you react to that competition? To the question specifically posed here, I think the unique thing that we do is the scale and breadth that we operate at. Meaning we have people that are, two folks in a garage that are just getting started. And we have folks like the Pipes of the world, where there's more of a finance team. We work very closely with folks on staff, et cetera, et cetera. And I'm just not aware of other firms that can kind of scale like complexity in the way that we can, or that operate with the number of customers we operate with. So today, Pilot works with over 1,000 startups of various sizes and stages. And so even though there is a long tail of outsourced accounting companies or individuals, someone you might hire on Upwork for $5 an hour or whatever it is, there's no one that is really kind of operating at the size and scale that we do, or with the quality bar that we operate at. So I think that maybe the specific answer to your question is that, which is I just don't think anyone does it as deeply or as broadly as we do, and that is a real moat. That's a real benefit. We've seen the movie. We can help you in ways other people can't. I think the more generic answer is, well, look, what is your differentiator, and how do you double down on the thing that makes you unique? Ideally, the thing that structurally makes you unique, that other people in the market cannot trivially copy. And I'm speculating here, and maybe Lukas, you can tell me kind of your view on this for Pipe, but I think for you folks, I assume it must be like the network that you're building kind of on both sides, that there is a real marketplace here. How do you think about the differentiator that sort of makes you folks unique?
I think to us, right, and this is any marketplace, right, is where once you have it figured out and you have it scale, right, like it fuels itself. So like we have a slide somewhere, and like effectively all of our fundraising decks, where it's like, add more sell side liquidity, adds more buy side interest,
right,
drives buy side competition, lowers prices, adds more sell side liquidity, right? Like, and it just keeps going like this. I think really the true thing that differentiates us from any type of balance sheet lender is that they have a fixed cost of capital. They have somebody from some bank that has said, hey, look, here's our little credit box. Every company that comes into this will be, will cost you, whatever, 10, 11, 12%. Then you tack on your markup, and that's what you give your customers. Now, what that does, unfortunately, is probably gives some of your customers a really, really good cost of capital versus their risk profile, but it actually penalizes the best of your customers, where they actually, they fit into the credit box by virtue of actually being too good for the credit box. And it makes either for adverse selection, makes for, a subpar per customer experience. I think what we can do by virtue of rating the assets and then just allowing the market to take care of the pricing mechanics is where you can have, and we use, classic Wall Street kind of like just ratings methodology, because that's what folks are used to. So we start at AAA, go all the way down to single C, right? You allow for AAA and single C to be very, very different numbers in like different universes, right? So you can serve both customers. And the buy-side participants can build a portfolio consisting of the assets that they actually are interested in, right? Some folks, if you think pension funds, insurance money, right? Like all of those folks would never buy anything that's single C. But if you go into, classic credit funds, family offices, where you have singular decision makers potentially, and they might be willing to roll the dice as long as, the yield is the risk adjusted return is high enough. So I think that that's really important to, in a marketplace, or the benefit of a marketplace, to allow to facilitate that diversity of interest, that diversity just of sell-side participants.
Yeah, I love it. It's just like, it's more tailored than what a traditional provider can do, and that benefits everyone.
I think actually one thing on what differentiates you guys just from a customer's perspective, I think is that by virtue of also you guys not just being a bookkeeper that's hanging around in our QuickBooks and matching a few entries, you guys have built technology pipelines in order to get all of these other tools that we use in order to manage our business into one comprehensive, set of data that you guys then use to very efficiently do the books. I think what probably, is hard to quantify, But the moment you have thousands or 1,000+ customers go do this, your model just gets smarter, right? So like you guys have access to all of this training data. If you guys think about, like automated mapping, automated matching, that's just at some point you just have so much of a head start. It becomes very hard to actually catch up. Like somebody can try to underbid, but then you're getting into a very unfeasible, economically unfeasible situation. So that's super exciting, I think, for you guys.
Indeed, indeed. Well, look, I think we're basically at time here. Lukas, I wanted to thank you for taking the time, spending a lot of time with me. To folks who tuned in, thank you so much for joining. We'll be following up with a link to the recording after this, so you'll have that in your inbox. But I wanted to thank you all for joining and enjoy the rest of your day.
Awesome. Thanks, Waseem. I think one last thing I wanted to say, and thanks all for listening in. If you're interested in what we do at pipe.com, or if you have any questions we didn't get to answer right now, or we're always hiring, looking for smart people across the org. I'm always looking for people to add to the finance team. Lukas at Pipe, Lukas with a K, at pipe.com. Please shoot me a note. Excited to hear from you. Thanks,
Definitely.
Waseem.
And I put that contact information in the chat as well for both Lukas and me.
Amazing.
So please don't be shy about pinging us if there's stuff we can do to help.
Amazing.
Terrific. Thank you.
Waseem, cheers. Bye.
Cheers.